known that the RBI has announced the first bi-monthly policy of this new financial year. So let's look at the important highlights of the monetary policy review, which has been presented by the RBI Governor Raghuram Rajan with his team. So the important highlights of today's review is that, as everyone was expected, RBI has done it. That is, they have reduced the repo rate by 25 basis point. And with not that they have reduced the repo rate, they also have reduced the bank rate, the MSF, and for a change they have increased the reverse repo rate. So let's see with how much basis point they have made the changes in the policy rates. So the quick highlights of the review is the reduction in repo rate. The RBI has reduced the repo rate by 25 basis point, and to understand 25 basis point, remember 1 basis point equals 1 upon 100%. So this means that if we are talking about 25 basis point, then we are talking about 0.25%. So this means that there has been reduction in repo rate by 0.25%. So now what is the new repo rate now then? The new repo rate is 6.50%. Similarly, the RBI has reduced the bank rate. They have reduced the bank rate by 75 basis point. This means that it has been reduced by 0.75%. So the new bank rate is 7%. And also in the same way, they have reduced the MSF. So what is the full form of MSF? MSF is marginal standing facility. They have kept CRR and SLR remain unchanged. Matlab, CRR is at 4% and SLR is at 21.25%. And they have increased the reverse repo rate by 25 basis point. So this means that the new reverse repo rate is 6%. And one more important point in the policy rates is that RBI has reduced the daily CRR requirement maintenance. They have reduced it to 90% from 95%. This means that RBI reduced the daily CRR maintenance to 90% from earlier 95%. So these are the important highlights related to the policy review. Let's look at some of the important points, some of the other points which have been presented in this monetary policy review. Some other important points which were mentioned in the today's monetary policy review, which was done by RBI, is the first point is RBI has retained the growth rate, that is the GDP rate, for the fiscal year 2016-17 at 7.6%. The second important point is that they have kept the CPI, that is the Consumer Price Index inflation rate, at 5% for the year 2016-17, for the next fiscal year. The next important point is that they have reduced the policy rate corridor. You must have noticed that always the difference between bank rate and repo rate was, there was a difference between 1% between bank rate and repo rate. But now they have reduced that rate. Now they have reduced that difference from 100 basis point to 50 basis point. This means that after this monetary policy review, the repo rate is 6.5% and the bank rate is 7% and even the MSF is 7%. So the policy rate corridor, which was supposed to be 100 basis point or 1%, has been reduced to 50 basis point. As you can clearly see, the difference is 0.5%. And one more important point in today's monetary policy review is that RBI mainly has focused on liquidity management. They have proposed many changes which will increase the liquidity within banks. Now, you must have been, you were a bit confused. What is liquidity? Liquidity is nothing but liquidity, availability of money. Now, what does that mean? You must have heard about liquid assets. Liquid assets are those assets which are very easily converted into cash. For example, gold. For example, even some of silver also. And in today's monetary policy review, the governor clearly told that they have taken several measures which will increase the liquidity, that is availability of money or cash with the banks. And what is the purpose behind liquidity? If the bank is having more money, then it will help the bank to grow the business. Because if the bank money is available, then money can be lent to the productive sectors, and which can help in growth. So this is the point. So many measures has been introduced to smoothen the liquidity supply, that is the availability of money with the bank. So you can relate this point from the point of CRR requirement. RBI has reduced the CRR requirement from 95% to 90%. So by that extra 5% gap, this will help the increase in liquidity in the banks. So these are the important highlights of today's monetary policy, the first bi-monthly monetary policy review. So now let's have a close look on how the policy rate changes can impact the supply of money or can impact the market. To study this, first of all, you must know what are the policy rates. So, bank rate, repo rate, reverse repo rate. So, what is the definition? Bank rate. Bank rate is nothing but it is the interest rate charged by RBI on long-term loans given to bank. Long-term loans interest rate charged is known as bank rate. And repo rate, it's same, it is also interest rate charged by RBI, but for bank rate the interest rate is on long-term loans. For repo rate, the interest rate is on short-term loans. And bank rate and repo rate are basically the interest rate which is charged by RBI as the banks are taking loan from the Reserve Bank of India. But when we talk about reverse repo rate, to understand it, reverse means opposite, ya ulta. So to study reverse repo rate is nothing but it is the interest rate offered by RBI on the deposits of banks in RBI. So interest rate given by RBI on the deposits of banks in RBI. And with these three rates, we have one more rate which is termed as MSF, that is marginal standing facility. Actually, MSF is a window by which a bank can take loan from RBI in an emergency situation. This clearly means that when banks are in emergency, so the last resort for them is RBI. And we can say this by this MSF. And in examination we have seen a question comes, who is regarded as a lender of last resort? So the answer for this is RBI. Why? MSF is a window which has been given to banks to borrow from RBI in an emergency situation. It is a rate at which banks are able to borrow money from RBI overnight against government securities. GSEC here means government securities. So these are the policy rates. Now let's discuss what can be the impact of the changes in the policy rates. Now let's suppose if the bank rate increases But in this case, we have seen a decrease in bank rate. But if a bank rate increases, so what do you mean by an increase in bank rate? The loan from RBI then become expensive. Obviously, the interest rate increase. If the bank rate is increased from, let's say, 6 to 8%, interest rate increases, thus leads to less loan taken by bank and will result in increase in money supply. Matlab, the flow of money in the market. So, if bank rate increases, money supply will decrease. So from here, one point comes, all those policies which results in reduction in money supply are known as contractionary monetary policy. All the policies that results in reduction in money supply is regarded as contractionary monetary policy. The same case will be therefore if the repo rate increases. But in the monetary policy review, what we have seen that the repo rate has increased. So what could be the impact of the repo rate decrease? We have seen that the Reserve Bank of India has announced a policy cut by 25 basis points. So if repo rate will reduce, then loans from RBI will become cheap. Obviously the interest rate has been decreased, so loans जो हमें मिलेंगे that will be cheap. Thus, and when there is anything is cheap, we will demand it more, so more loans will be taken by bank, and which will lead to increase in money supply, which will lead to increase in money supply, because when the banks will take more loans, they will be having more loans and they will be providing more money to its customers. So my next point here is, all the policies, by seeing this situation, policies result in increase in money supply are known as expansionary monetary policy. So in the monetary policy review, we have seen that the bank rate, in monetary policy we have seen bank rate reduced, repo rate reduced and MSF reduced. So by seeing all these situations, for given these three situations, RBI is following an expansionary monetary policy in this case. I think this point should be clear. Obviously, MSF is also an interest rate which is charged by RBI. So when MSF will be reduced, the interest rate will be reduced. It will be cheaper for them and they can take more loans in emergency situation. Now, what we have seen in this monetary policy review is that RBI has increased the reverse repo rate. Maybe because RBI wants the banks to have some money to face the uncertainties. Why? Because what we have seen, what is reverse repo rate? Reverse repo rate is nothing but is the interest rate which can be earned by the banks from the deposits in RBI. So what we have seen, they have increased by 25 basis points. So when there is an increase in 25 basis points, the banks will increase their deposits in RBI, and when they will increase their deposits in RBI, the funds for money for the public will become limited. The situation is, deposits of banks in RBI will increase, shortage of money among banks, because what could be the reason? Because they have deposited in RBI, which can lead to reduction in money supply. That is again a contractionary monetary policy. But seeing the situation, the overall impact of this monetary policy will be an expansionary monetary policy, and because of the policy rates cut, we will clearly see that the loans available for the general public will become cheaper. As RBI governor clearly told that the MCLR, that is marginal cost lending fund rate, will also result in reduction in the interest rate which is charged by the banks from its customers. That's it for the monetary policy review. Keep visiting us in case of any queries, in case of any suggestions, you can write to us on the same video, and you can follow us regularly on our web portals, bankersadda.com, sscadda.com, adda247.com, and your own currentaffairs.com. Thank you.